Welcome to The Explainer. Today, we're digging into a really fascinating new analyst report on the tech giant Broadcom. And let me tell you, it makes a very bold, very contrarian call on the company's future in the AI boom.
So to really get why this call is so bold, we first have to look at a situation that, well, on the surface, just doesn't add up at all. Okay, so the whole thing kicks off with this real head-scratcher that happened right after Broadcom's latest earnings call. It's one of those classic moments where the news is great, but the market's reaction is, well, the complete opposite. So what actually went down?
I mean, look at this. The news itself was, by all accounts, fantastic. Broadcom came out with strong fourth-quarter results. They gave this super impressive guidance on future AI revenue. And get this, they announced a massive new $11 billion AI chip order. So you'd think the stock would soar, right? Nope. The price dropped 5%.
And that bizarre reaction is exactly where our analyst from Morningstar comes into the picture. They basically took a step back and said, hold on a second, I think everyone is missing something big here.
And this quote from their report really just sums it all up. The analyst argues that this dip is a classic case of missing the forest for the trees. In other words, they think the market got so caught up in the tiny details that it completely ignored the massive long-term opportunities staring it right in the face. And it didn't just talk the talk. They put a huge number on that confidence. They didn't just shrug off the dip. They responded by jacking up their fair value estimate for Broadcom stock all the way to $480 per share. That is a huge jump, and it just screams confidence in where this company's headed.
Okay, so you're probably wondering, what in the world is fueling this incredibly bullish view? Well, according to the report, it all boils down to one simple, powerful thing: the AI rocket ship.
The analyst is pointing to what they call an astronomical level of growth driven by this absolute tidal wave of new business. We're talking phenomenal demand for Google's custom AI chip, the TPU. There's that huge new order from Anthropic. And on top of that, another brand new custom chip customer is already lined up. The pipeline just looks ridiculously strong. And what's really interesting here is that this isn't some sudden change of heart. You can literally watch the analyst's optimism accelerate over time. Just a year ago, their estimate was at $190. Today, $480. Their conviction has clearly been building as Broadcom's AI story gets stronger and stronger each quarter. But here's the thing. According to the report, this explosive AI growth isn't just some lucky break or a flash in the pan. It's actually built on an incredibly strong and durable foundation that protects the business from competitors. And the financial term for that foundation is an economic moat. The report gives Broadcom a wide economic moat, which is basically the highest rating you can get. Just picture a castle with a super deep, wide ditch all around it, making it extremely difficult for any rivals to even think about attacking. So how exactly is this fortress built? Well, the report says it stands on two main pillars. First, you've got intangible assets in their chip design. We're talking about technology and expertise that's almost impossible for anyone else to replicate. And second, you've got really high switching costs in their software business, which makes it a total pain for customers to leave. And here's where it gets real. Let's look at those pillars in action. On the chip side, they make these specialized FBAR filters that are absolutely critical for the Apple iPhone. And this technology is the result of 40 years of development. Good luck copying that overnight. Then on the software side, they are so deeply integrated with their large customers that the report notes over 80% of them use more than 5 different Broadcom solutions. Tearing all that out to switch to a competitor, it would be a complete nightmare.
Okay, but let's be real, no investment is a sure thing. So to give us the full picture, the analyst also dives deep into the counter-arguments, the stuff the skeptics or the bears are worried about. And this really sets up the classic bull versus bear debate. The bulls are all about the company's incredible efficiency, its top-of-the-line technology, and of course, riding that huge AI wave. The bears, on the other hand, are pointing to some real risks, like having too many AI eggs in one customer basket, slowing growth in their older software businesses, and the challenge of finding the next big acquisition.
The report also flags a few other important risks to keep on your radar. There's what's called key man risk, which means the company depends a lot on its superstar CEO, Hawk 10. There's also supply chain risk, since they lean so heavily on just one supplier, TSMC. And finally, there's the very real possibility they could lose some wireless chip business from Apple in the near future. All right, so let's pull all of this together. We've got the incredible growth, the strong fortress, but also some very real risks on the table. So where does the analyst land? What's the final verdict? Well, it all comes back to that forest for the trees idea. The report concludes that the market sold off the stock because it was worried about the trees, little things like a slight dip in the profit margin on individual AI chips. But the analyst is basically shouting, "Hey, look at the forest!" The big picture is that these chips are so profitable overall that they actually boost the company's total bottom line and represent an absolutely enormous long-term opportunity.
So the ultimate takeaway from this analyst is pretty clear. They see the market's knee-jerk reaction as a golden opportunity to invest in a major AI powerhouse. The belief is that this astronomical growth in AI will far, far outweigh any of the smaller, short-term concerns that caused that initial sell-off.
And really, that leaves us with a great question to think about, right? When news breaks and markets are moving fast, it forces us to consider what we should pay more attention to: the immediate, emotional reaction in the moment, or the deeper, long-term analysis.